Let's assume back, guys. So before break, we were studying about leases. Now we're starting with a new standard called as share-based payment that is governed under Ind AS 102. Now, before we start the share-based payments, let's understand what exactly is share-based payments. While in class 12, or you can say in your CA Inter as well, you would have studied a concept called issue of shares for consideration other than cash, right? So what was happening there is you purchased some assets, okay, or you took some services, and the payment of which you are not doing in cash, rather you are doing it in by issue of shares, right? So that's what was happening in that case. Now the similar situation is happening in share-based payments also. So what is happening in share-based payments is we are issuing the shares. We are not receiving cash, but rather we are receiving the goods, or we are receiving some assets, or we are receiving some services. Is what is happening in this case also. Okay. Now, so the meaning of share-based payments is entity delivers the goods. Okay. Not sorry. There is a mistake here. The entity receives the goods, or just a minute. Yeah, entity receives the goods, assets, or services from the employees or from non-employees, might be from a third-party vendor. Okay, and the consideration of which is paid by the entity in the form of shares of the own entity, or you can say cash based on shares of the own entity. Now you must be wondering, if it is cash, then how come share-based payments? So, but understand, let's suppose I'll give you an example of it. Let's suppose I have purchased this calculator. Okay, now definitely I have to pay the consideration for it. So I'll say the price of this calculator is 400. I'll pay 400 to you. That transaction is not covered here. I'll say this calculator is worth 400, but I will give you 2 equity shares of my company. Okay. Now what when I have to give the equity shares, whatever is the value, then doesn't matter. I will give 2 equity shares. That's all. This transaction is covered here. Again, third, I'm saying I will give you cash based on value of 2 equity shares of my company. Now let's suppose on the day when I have to give the cash, the value of this 1 equity share of my company is, let's suppose, rupees 10 only. So in that case, I will pay only 20, not 400. So my obligation is to give either cash, or my obligation is to give cash based on the shares of the company, or my obligation can be to give shares of the company. If my obligation is to give cash solely, that transaction is not covered here. If my obligation is to give shares of the company, that transaction is covered here. Or if my obligation is to give cash based on the shares of my company, the cash based on the value of the shares of my company, that transaction is also covered here. But now, if I am delivering the shares of the company, it is called as equity settled share based payments. And if I am giving the cash based on the shares of my company, it is called as cash settled share based payments. Is it clear? The meaning is clear, everyone? Now understand the applicability. Now this applicability is very much important, guys. What happens if I am issuing the shares? If I am issuing the shares to any party in the capacity of that party being a shareholder, let's suppose you have paid me the price for taking the shares of the company itself, that transaction is not covered here. Okay, so basically or let's suppose you are the shareholder of my company and I'm issuing bonus and I'm giving you shares of the company, that transaction is again not covered here. Okay, or let's suppose you are already a shareholder of my company and I'm coming up with a follow-on public offer. Okay, basically the rights issue. Now if I'm coming up with a rights issue, I will give definitely preference to the existing shareholders, right? And when I give preference to the existing shareholders and I give you shares, now you are getting these shares in the capacity of you being a shareholder, right? So whenever you get the shares in the capacity of being a shareholder, that transaction is not covered here. But if you are getting the shares in the capacity of being a vendor, that transaction is covered here. So vendor-vendee relationship is what matters here, and not the shareholder and the company relationship is what matters here. Is that clear, the applicability? Now, that's what is written here. Any transaction with shareholder of the company in capacity of them being a shareholder is not covered here. Now let's suppose you are a shareholder of the company. Okay, from you I purchase some assets for which I am delivering you the shares. Even though you are a shareholder, but this transaction is not in the capacity of being a shareholder, right? So this transaction will be covered here. So what happens is, or what matters is, in what capacity are you doing the transaction. If you are doing the transaction in the capacity of being a shareholder, not covered. If you are doing the transaction in the capacity of being a vendor, that is covered here. Okay. Now, in financial instruments, you would have studied a concept called as executory contracts. Can you remember that? So what happens whenever there is a contract to buy or sell a non-financial item, okay, and we are taking the delivery of that. So we told that whenever we take the actual delivery or the physical delivery of the non-financial item, that is covered under separate standard, and if we do net settlement, that is covered as part of Ind AS 109 derivative contracts, right? Now here, let's suppose I have entered into a contract with a person to take delivery of a particular asset. That's a non-financial item for which I will give you the shares of my company. Okay. Now, if my intention is to do net settlement, means I will not deliver the shares, you will not give me the delivery of the goods services, rather we'll just do the net settlement. That transaction is covered in Ind AS 109. That's what we studied in Ind AS 109 also. That is called as derivative contracts, right? But if we take the physical delivery, definitely we have to issue the shares also. When we issue the shares by taking the physical delivery, that transaction will be covered here in Ind AS 102. Okay, but again, understand this way: executory contracts. Trying to give you a holistic picture of the executory contract now. It's a contract to buy or sell a non-financial item. Agree? There can be two possible outcomes of it. One is a gross settlement and one is a net settlement. So if it is a net settlement, definitely it will be covered under Ind AS 109, that is financial instruments derivative contracts. Clear? Now, if it is gross settlement, definitely will take delivery. This means we'll take delivery. When we take the delivery of the non-financial item, what question that comes up is, how are we settling the transaction? See, we got the goods from the vendor. We might settle in the form of cash, or we might settle in the form of shares or cash based on shares. If we are settling in the form of cash, that transaction is also not covered here. But if you are settling in the form of shares or cash based on shares, that transaction is covered under Ind AS 102, share based payments. Is it clear? Now, can you see the holistic view of executory contracts? Is it clear now? Makes sense. Now, see the share based payments earlier. Okay, if you would have studied in CA Inter, share based payments, what happens in that case? In there is a guidance note applicable. Okay, in India there is guidance note applicable. Okay, which deals basically with share based payment to employees only. But Ind AS 2 is much more broader. It says share based payments cannot be only for the employees. That is called as ESOPs, right? It can be to employees, it can be to the other vendors also. Okay, so we will be dividing our chapter into two parts: share based payment to the employees and share based payment to non-employees as well. Okay, now, so what happens when we give the share based payment to the employees? First date when it is communicated, okay, this is the date it will become effective, the ESOPs. Okay, that date is called as the grant date. Okay, now let's suppose there is a definitely when I give the ESOPs or the share based payments to my employees, it can be either conditional or it can be unconditional. Assuming it is a conditional, so definitely there will be some vesting conditions to be satisfied over the vesting period, right? So this is called as the vesting period. This is called as the vesting period. Okay, now the vesting conditions can be in the nature of service condition, can be in the nature of market condition, can be in the nature of other non-market conditions or performance conditions, we can say. Okay, now once those vesting conditions are satisfied, comes the vesting date. The vesting date is the date when the employees become eligible to exercise the ESOPs or the share based payment plans. Okay, now this is called as the exercise period. Exercise period is the period wherein the employees can exercise the rights, okay, during this period at any given point of time. During this period at any given point of time. So now, what is a grant date? Grant is the date when the share-based payment is approved by the shareholders and it is communicated to the employees. Now, what is the vesting date? The period over the what is the vesting period? The period over which the vesting condition needs to be satisfied. Now, what is the exercise period? The period over which the share-based payments can be exercised by the employees. Clear, everyone? The basic terminologies. Now, coming to fair value. Now, why do we need fair value? See, understand. If I am giving the share-based payment plans to my employees, it can be equity settled, it can be cash settled. Okay, it can be either of them. Now, if I am giving to them, let's suppose they have to serve for a 3-year period. Okay, definitely at the end of the 3rd year, I will give them either the cash or the equity shares. But why do we give equity options or the cash settled options to my employees? So that they will serve during this 3-year period in a manner which is required by the entity, right? So tell me, if I am delivering the cash or the equity shares to the employees at the end of 3rd year, is it at that date I am getting the service? No, I am getting the service over this 3-year period. Means I have to recognize the cost of that payment, whether it is in cash or the equity, over the 3-year period, right? Now, how will I recognize the cost? The cost will be recognized in this manner. See, for the company, it is number of employees multiplied by how many options I have given to each employee, okay, multiplied by what is the fair value of each option, okay. Then what is the expired period divided by total vesting period. So this will give you the total expense to be booked till date. But now here I have to reduce the expense that is already recognized in the previous years, okay. That will give you the amount of expense that you have to book in the current year. See, this formula for calculating the option expense in each year might seem very easy here with this one, but there are a lot of estimates or judgments involved. Understand, number of employees. See, when I granted the ESOPs to my employees, it might be the case that there were 2000 employees, but during this 3-year period, few employees left, few employees joined, right? So I have to again take on the best estimates, okay, that to the employees to whom these ESOPs were granted, how many of them will actually exercise on that date. Okay, so what I have to do is I have to take what is the number of employees on the grant date minus employees left till date. Let's suppose there were 3-year service condition, 1 year already passed, out of 2000 employees, 100 employees already left. So I will minus how many employees already left till date, minus I have to also adjust for the employees that I expect that they will leave in the future. Okay, see, basically understand, I have to analyze basically what will be the cost at the end of the 3rd year. When I have to pay the amount, what will be my total cost? Okay, and in the process of calculating this total cost, I might have to use certain estimates or the judgments. Now this amount is a judgment. This number is judgment, right? Because I know that I will apportion the cost over the 3-year period, only those costs which is actually my cost for that period. So what I'll do is I will remove these employees which I am expecting that they will leave the company. Okay. So now options per employee will be given in the question of fair value. So fair value, it's said that whenever it is an equity settled, I will take the fair value on the grant date. Whenever it is a cash settled, I'll take the fair value on the reporting date. Okay. Though I don't want to go much into detail, the logic behind this, but I'll definitely touch upon it. Tell me, Reliance has issued equity shares. Okay. Will Reliance, okay, now with the change in the price of the equity in the market, will Reliance change the equity capital in the balance sheet? No. Okay, now Reliance has issued a liability. Okay, with the change in the value of liability, will the Reliance change the value of liability? Yes, right? So that's what is happening here as well. So equity settled will take the fair value on the date of issue of the instrument, that is on the date of grant date. But for cash settled, which is a liability, we will revalue on each reporting dates. Okay, we'll revalue on each reporting dates. That's what is here. Fair value. For equity settled, we'll take fair value on the grant date, and for cash settled, for cash settled will take the fair value on each reporting date. Is the logic clear to everyone? Is the logic clear to everyone? Okay, fair enough. Now, coming to vesting conditions. Guys, understand what happens is, as I told that during the vesting period, the vesting conditions has to be satisfied. So you need to understand, whenever we give share-based payments to my employees, why do we give it? Basically, share-based payments are given to the employees to retain the employees in a longer period. Okay. Now, let's suppose if I give you can say to my employees that I will give you ESOPs worth rupees 10 crores to at the end of third year, okay, and his salary is somewhere in the same, you can say 30 to 40 lakhs per annum, definitely 10 crores will attract him, right? So he will not leave the company for that 3-year period. Okay. So now what is happening here, this 3-year period is called as a service condition. Only thing the employee has to do is to serve the company for 3 years. Okay. That is called as a service condition. That is called as a service condition. Okay. To remain in service for a period, specified period, is called as a service condition. Now, second is performance condition. So in the performance condition, apart from the service condition, apart from the servicing, the employee is required to do something additional also. Now, what else? The performance condition can be of two types. One is market linked, another is non-market linked. Let me discuss the non-market linked first. Non-market linked means what? Let's suppose Reliance gives a target to its sales team that you have to touch the revenue of 10,000 crores for this particular year. That's called a performance condition. Okay, that's called. So if you touch the 10,000 crores limit, I will give you ESOPs of this value. Okay. Now that's what is called as the, you can say, performance linked, or you can say non-market linked performance condition. Or let's suppose it says that you have to increase the profitability by this much, or you have to increase the revenue by this much. Okay. Or you have to decrease the cost by this much. Means a factor which is within the control of the employee. Okay. See, increasing the revenue, increasing the profitability, increasing or decreasing the costs. All these factors are within the control of the employees. If the employees work effectively, the revenue can increase, the cost can decrease, the profitability can increase. Okay. But now coming to market linked, I will give you ESOPs only if the market price of my share touches this limit. Is it within the control of the employee? No. How can employee derive the market share of the company, market price of the company, right? So that's not within the control of the employee. Okay. Now, see, market, this one, whenever it's non-market linked, it says it's increase in earnings, decrease in cost, or etc. Market linked, increase in the market price of the entity, increase in market price of the shares of the entity. Now you write here one more thing. Whenever it's non-market linked, it's within the control of the employee. Within the control of the employee. It's within the control of employee. But if it's market linked, it's beyond the control. Now, any factor which is within the control of the employee is called as an estimate, right? So now what happens if it is non-market linked? Let's suppose the Reliance says that if you reduce the costs by 20%, I will give you ESOPs within the 3-year period. At the end of first year, the employees believe, yes, the cost will get reduced by 20%. So I will reduce the pro rata cost for that period. Now coming to the second year, the employees believe, or the company believes, that the cost will not be reduced by 20%. Okay. Now what happens? The company will not record the costs for in that period. Additionally, the company will also reverse the cost which is recognized in the previous year. Okay. Because the estimates have changed now. According to today, an expense of 0 has to be booked, right? And we have already booked some expense in the previous year, right? So what will happen? I will reverse the expense that is already booked in the previous year. That's what is required to be done. But in the market linked, at the end of the first year, can I estimate that what will be the price at the end of third year? No, I cannot, right? At the end of second year, can I estimate? No, I cannot estimate what will be the price after a week also. How can I estimate for a year, right? So standard says whenever it's a market linked condition, always book the expense. over the estimated vesting period. Okay, over the estimated vesting period, you will always book the expense. Okay, no matter what you believe that it will be exercised or it will not be exercised, no matter what, you have to always book the expense. But when it's a sorry, yeah, but when it's a non-market linked, if the estimate changes, you will reverse the expense also, or if the estimate changes subsequently, you can book the expense in the third year. Okay, so that's what. So basically, what it says is, for non-market condition, you have to reassess at each reporting dates. You have to reassess at each reporting dates. Okay, if required, reverse also. Okay, now this needs to be assessed at the grant date also, and no further reassessment is required. No further reassessment is required. Yes, might be when the vesting period is over, okay, and you feel and you can get to know that the vesting conditions has not been satisfied and the ESOP will not be issued. So whatever reserve or a liability that you have recognized, you might have to reverse that then, but not during the vesting period. Okay, so during the vesting period, you will record the expense as it is in a normal manner. Is it clear, everyone? Anyone having any queries so far? Good. Now, one more point. If the share-based payments are unconditional, see, we discussed about the conditions, but what if it is unconditional? So what I will do here, in that case, I will recognize the whole expense today itself immediately, right? And I will record a share-based payment reserve. Okay. So basically, it says if the share-based payments are unconditional and that is vests immediately, entity should record an option expense immediately and followed by a share-based payment reserve or a share-based payment liability. Okay. If it is a equity settled, reserve. If it's cash settled, then liability. Is it clear, everyone, so far? Fair enough. Now, let's understand the general entries for equity settled and cash settled share-based payments. Now, for equity settled share-based payments, on each reporting dates, whether it's equity settled or cash settled, we will record share-based payment expense, that is called as employee benefit expense, right? So what we'll do is we'll record employee benefit expense. If it's equity settled, we'll recognize share-based payment reserve. If it's cash settled, we recognize provision for share stock appreciation rights, or we can recognize share-based payment liability, as the case may be. Clear, everyone? On each reporting dates during the vesting period, on exercise dates, see what happens when it's an equity settled. Okay, the employees have to give the exercise price. Let's suppose Reliance says to the employees that at the end of the third year, I will give you the shares of my company, but you have to give me a nominal price for that. Okay, that is called as the exercise price. Okay, so what happens? The company will first call the exercise price and then give the shares. So now, what is generally to be done? Bank account debit for the exercise price to be called from this one. Then share-based payment reserve, which I have recognized here, I will debit it off, and then from there I will issue equity capital, and whatever is the differential, I will transfer to securities premium. Can you please have a look at this journal entry, the first one, this entry? Have a look at this entry and tell me, is it clear, everyone? So first I will call exercise price, that is bank account debit. Then I will debit the SBP reserve, which I have credited over the vesting period, and from these two balances I will issue equity capital, and whatever is the balance will be transferred to securities premium. But what if it gets lapsed, means the employees didn't exercise it off? In which situation the employees will not exercise? Employees will think paying this exercise price will not be valid for these shares. Okay, so employees might not purchase the shares. So what employees will do? Employees will not purchase. So share-based payment reserve, which if I have created any extra, will be transferred to retained earnings or any reserve. Okay, is it clear, everyone? But now understand, cash settled is not that way. See, in equity settled, there were two columns, exercised or lapsed, because you have to give something to get the shares. In cash settled, it's not the way. I am giving you cash net of the exercise price. Now tell me, if I am giving you cash, can anyone will any employee deny? No one will deny. So there is no question of being lapsed. Even if it's 10 rupees also, why will anyone deny, right? So there is no point of being lapsed in this case. So it can only get exercised. Okay. Now, by the intrinsic value on the exercise date, what is the meaning of intrinsic value? Market price minus exercise price. Clear? Now, understand few points related to cash settled share based payments. That is, we will remeasure the SBP liability. We will remeasure the SBP liability on each reporting date by using the fair value on each reporting date. Agree? Now, subsequent to the vesting period means vesting period is got over. See here, this chart. Vesting period is already over. Okay. Now you are in this phase. You are in this phase. You are in this phase. Few employees got exercised the options here, but few employees have not yet exercised the option. Okay. Why? Because they might think that the share price will increase. Then I will exercise. Then I will get a higher value of it. Okay. So they have not exercised it yet. So for the remaining share based payment liability, still I have to revalue using the fair value. Okay. Because see, understand, it's a liability for me, right? And I have to settle this liability at its fair value, right? So now definitely that's the reason why I will keep on remeasuring it at its fair value till the time it is settled. Now, provision for SAR, that is stock appreciation rights, or you can say it as a SBP liability, is to be settled at intrinsic value, that is market price minus exercise price. So understand, during vesting period, you will do the accounting as per fair value. During exercise period, you will do the accounting as per fair value. But on exercise date, you will do the accounting as per intrinsic value. Any change in the fair value or any change from fair value to intrinsic value will be transferred to P&L as employee benefit expenses. Is it clear, everyone? Okay. Now, this is a short summary of what we've discussed so far. See, the share-based payment can be of 4 types now. Equity settled, non-market, equity settled, market. Cash settled, non-market, cash settled, market. Understand, expense booking. Always we have to take, for non-market, we have to take best estimate. But for equity, for market, we have to always book the expense. Okay, whether the conditions are being met or not. Okay, let me write here, whether the conditions are being met or not, irrespective of the fact. Number of employees, I will always take on the best estimate, that is number of employees in the grant date minus the employees already left minus the employees that are expected to leave the company. Okay, now the fair value. For equity settled, I'll take grant date. For equity settled, I'll take grant date. For cash settled, I'll take reporting date. For cash settled, I'll take on reporting dates. Total vesting period. For non-market condition, I will always take estimated. But for this one, market condition, I will take lower of estimated or actual. Understand? What happens? There is a market condition that I will give you the ESOPs once the market price is achieved. Okay, first year not achieved. Second year not achieved, third year not achieved. Okay, the vesting condition was ideally 3 years. In this 3 years not achieved, but it is achieved in the 4th year. Okay, so might be I will give the ESOPs in the 4th year, but I will book the expense only in the 3rd year. Or let's suppose the condition is achieved in the 2nd year itself. Okay, so then in that case I have to book the expense in that period. Okay, so that's what basically I have to see whether what is the estimated period and what is the actual period, and accordingly when I am giving the shares, okay, in that period I have to book the expense. Is that clear, everyone? So this was the normal share based payments so far. Okay, now a question has come in the exam also from this one, this part. Just a minute. in the past we can see a question from this one. We have already seen a question this one, that is unconditional payment. Okay. Now, but if you see last 2-3 attempt paper, they are asking from share alternatives, right? Option alternatives, or they are asking from modifications, right? Now, so these concepts also become important nowadays. Now, coming to modification or repricing, we say it is. What is the meaning of modification of share-based payment plans, or you can say it is a repricing? What is the meaning of it? So what happens? The whole intent to give share-based payments to the employees is to retain the employees. Now think about a company whose market price is decreasing day by day, decreasing day by day. Don't you think the employees will think, anyways the price is decreasing, so no point staying in the company because the fair value of the options are anyways decreasing. But the company also knows this fact. So what will the company do to make this attractive, to make the options more attractive? The company decreases the exercise price, because see, the fair value of an option is dependent upon two facts: the market price of the share and the exercise price. Market price cannot be controlled, but exercise price can be controlled. So if I have to increase the fair value, the company decreases the exercise price. Once the exercise price decreases, the fair value increases, and again the option becomes attractive, right? So this is a strategy by the company again to attract the employees, to retain them in the company. So now this is done. So favorable or unfavorable, might be a case that exercise price can be increased also. Okay. Now we'll discuss for each of them, don't worry. Favorable to employees means exercise price is decreased. Now when the exercise price decrease, definitely the fair value will increase, right? Now standard says whenever the fair value increases, what you have to do is the normal expense booking which you are doing, continue doing that. There is no change in that, not a single change in that, but just calculate what is the change in the fair value due to this modification. What is the change in the fair value due to this modification, which you apportion over the remaining vesting period, Now see here, it says recognize option expenses as usual, which you are doing normally. Then incremental fair value, recognize as expense over the remaining vesting period. Okay. Now what is the meaning of incremental fair value? It says fair value before modification minus fair value after modification on the date of modification. Okay. Let's suppose today is the date of modification. Okay. Now, so for as of now, I have not yet announced the modification. What is the fair value now? Okay. Now, after I announce the modification, so definitely the fair value will increase. Now, what is the fair value? I will compare these two fair values and I'll calculate the incremental fair value. This incremental fair value has to be a portion over the remaining vesting period. Okay. Let's take up an example also. Do you want to solve this example? A very easy one. Giving it 5 minutes time. Please solve it. Is the question clear to everyone? Basically, 1000 options has been given to 2000 employees on 1st April 20x1. The fair value on the grant date is 1.20. It changes to 1.30 and then subsequently to 1.25. Okay. The number of employees given 1850 and 1840 employees, means a few employees have left the company. Okay. Now, this is the best estimate of employees. Okay. Okay. Further, now it says the fair value of the options have been continuously decreasing, and on 30th of September it decreased to 0.90. Okay, and then the companies decreased the exercise price, which led to increase in the fair value, and the increased fair value is 1.05. So can anyone tell me what is the incremental fair value? Pardon? It's 0.15 per option. Agree? Now let's calculate how exactly we'll do the accounting for it. Any entry here? No. Here, coming to on this year end date here, what is the amount of expense? Please tell me the expense amount. 2000 multiplied, sorry, not 2000, it will be 1850. 1850 of employees multiplied by 1000 options. What is the fair value? 1.2 on grant date. Equity settled options 1.20. Okay. Now if it is 1.20 now here, then how many, what is the service period? 3 years. So 1/3. So what is the amount? Pardon? 7,40,000. So entry will be employee benefit expense account debit to SBP reserve 7,40,000. Clear? Now similarly here at the end of year 2, at year end 2, it will be how many? 1840 employees. So 1840 employees multiplied by 1000 options multiplied by 1.20 is the fair value, multiplied by 2/3 minus how much? 740,000. Can you please tell me the amount? 7,50,000. 7,52,000. Now what is the general entry? General entry will be employee benefit expense account debit to share based payment reserve 732. Due to modification, did I change this entry in any manner? No. Now what I'll do is, this is the incremental fair value of 0.15. At year end 2, I will do one thing additionally now. I am using red pen for that. 1840 is the employee, 1000 is the options, multiplied by 0.15 multiplied by 0.5 by 1.5. Why point? See, half year, 1 year, 1.5 year, right? So 0.5 by 1.5. So that will give you a value of how much? 92,000. So now when you pass the journal entry, you will write plus 92,000 as well. Is it clear, everyone? Similarly, in the next year, you will do 1 by 1.5. Clear, everyone? Good. Sorry, 1.5 by 1.5 in the next year. So this is example also done. So is modification clear to everyone? Okay, before going on to cancellation, anyone having any queries? Come on, guys. That doesn't have any. Okay. It might be started decreasing in this year itself. After. No, tell me your question, Pap. Between 1.2 and 90. No. See, read this point here. Incremental fair value means fair value before modification and after modification on the date of modification. Okay, so on the date of modification, this is the fair value before modification, this is the fair value after modification. Clear? So we will compare 0.9 and 1.05, not 0.05 and 1.2. No, we will not compare these two. Okay. Anyone else having any queries? Come on, guys. Okay. Now, cancellation of share-based payments. Okay, but before going to cancellation, one more thing. Unfavorable to employees. What is the meaning of unfavorable? Means I'm increasing the exercise price now. Right? Now, if I increase the exercise price, what will happen? Tell me. Fair value will reduce, right? Now, is there any additional expense that I have to book? No, right? So fair value decreasing means you can say expense might decrease, but being a conservative, I'll say I'll not decrease my expense as of now, right? Whatever is the excess exercise price which I'll receive, I will get it received that time, and from that I'll share issues. Okay. So there is no treatment particularly for unfavorable modification for an employee. Okay. Now coming on to cancellation. Many a times what happens, the startup sectors cancel the ESOPs, okay, because what they see, when they notice that the share pattern is being diluted, okay, is getting diluted, so they try to cancel the ESOPs. Rather what they do is proceed. Employees, for them, what does it matter? The money, right? Whether you give in equity, you give in cash, doesn't matter, right? So what they say, I will not give you equity, I will give you cash, but I'm cancelling this ESOPs. Because for the promoters, the equity holding matters, right? Now, so that's what. So the ESOPs get cancelled, but the amount is paid to the employees in the form of cash. Okay. Now, so how will we do the accounting for this one? So standard says that whenever you are cancelling the ESOPs, let's suppose the service period was 3 years. Understand this concept. This is very easy, but understand. Okay. Let's suppose the service period was 3 years. At the end of first year, I cancelled the ESOPs. Okay, and I told that I will give you cash. But when I'm giving the cash, I will give the whole cash for the whole ESOP, right? But have I booked the expense for the whole ESOP? No, I have booked the expense only for the first year. It says on the date of cancellation, first book the expense, all the remaining expense. First book all the remaining expense. Okay, then you cancel the ESOPs. Okay, see, that's what is done here. Recognize entire SBP expense immediately in the year of cancellation. Okay, whether you are cancelling in the first year or the second year. Okay, first book the entire remaining expenses, then cancel from there. Okay, now calculate the amount of compensation which you have to pay, because what will happen is, if you are cancelling the ESOPs, definitely you will pay the compensation to the employees. Okay, so whatever compensation you have to pay to the employees, calculate the amount of compensation. Okay, now the compensation which you have to pay, see, share based payment reserve which we calculate represents the fair value, right? So it says the compensation amount which you will pay up to the fair value on the date of cancellation, will be adjusted from share based payment reserve. Any excess will be transferred from P&L account. Now, what a student make mistake here. Let's suppose I have to pay 10 rupees to the employee. I have a balance of 12 rupees in my share based payment reserve. Okay. The fair value on the date of cancellation is 8 rupees. I will request you to please note down these numbers in your notebook, all of you. The balance in the SBP reserve is 10 rupees, 12 rupees. The balance in SBP reserve is 12 rupees. The amount that I have to pay is 10 rupees as a compensation, and fair value on the date of cancellation is 8 rupees. Now, what generally a student does, a mistake in the exam, is they think, okay, I have to pay 10, my share based payment reserve has a balance of 12, I'll pay the entire 10 from the SBP reserve 12, okay, and the 2 rupees remaining from the SBP reserve I'll transfer to retained earnings. That is wrong. What you have to do is, you can pay only 8 rupees from SBP reserve. 2 rupees you have to take the impact to the P&L, and the remaining 2 rupees in the SBP reserve you have to transfer to retained earnings. Now understand, I'll explain it again. This is the SBP reserve balance, 12 rupees. This is what I have to pay 10, and fair value on cancellation date is 8. Okay, so what I will do is from SBP reserve of 12 I'll pay of 8. Okay, what remains? 4. 8 paid, 4 remains, right? Transfer to retained earnings. Now, but I have paid 8, 10, right? But I can adjust only 8 here. Remaining 2 to be paid will be adjusted from P and L. This is a common mistake that is done by the students in the exam. So please don't do this, okay? Like I have taken around 10 mock tests so far for FR, and in all the mock tests I have seen this mistake. Some other students will make this mistake. So please don't make this mistake, because if you have understood the concept properly and at the end you are doing this mistake, it will not fetch you any mark for that. Okay? So please do not make this mistake in the exam. These are, you can say, red areas, like basically an area where a student is prone to make mistake in the exam. Okay, and they know that they are not required to, it's not that the student doesn't know this concept, they know the concept, but still in the hurry to complete the paper they make this mistake. So these areas I have highlighted again in brown. Don't make this mistake, please. Okay, so let's solve this question also. I'll keep it. Okay. Yeah. See this question and try to solve it off, all of you. This question is on, I've taken only for the sake of explaining this part itself, which I've already explained to you now. So I think you can solve it off. Just make one change to the question. It is fair value is 90. Okay. Those who are using my book, please make this change in the book also. It's 90, not 95. From where I have taken these adjustments? From the book itself, right? These are actual questions in your ICI material, which I've just made it crisp, remove all the stories behind that, just for the adjustments which you can revise on the exam day. Let's try to solve this question. On 1st April X1, entity granted 2000 options to 10 directors. Service period is 3 years. Fair value grant date is 130 per option. Number of employees on 31st March X2 is 8 directors, 9 directors, 9 directors. Entity plan to cancel on this date. Planned to cancel on this date. fair value on this date is 90 and the compensation that I have to pay is 95. Now tell me what is the amount of expense to be booked for this year. Employee benefit, I'll take blue pen. Employee benefit expense account debit to SBP reserve is how much? 2000. Just a minute. 2000 options multiplied by 8 direct, multiplied by 8 directors, multiplied by 130 per option, multiplied by 1 by 3. So amount for is 2693 333. Very good. Now on this date, I am cancelling the contract. I am cancelling the ESOPs. So how many? What is the expense to be booked? Tell me. 2000 multiplied by 9 directors multiplied by 130 options. 130 per option is the fair value, right? Total amount I have booked as an expense minus 693 I have already booked. So I'll remove it off. So what is the amount? 16 lakh 46,667. Okay, fine. Now further. So tell me what is the balance in SBP reserve now? 1646667 plus 693 16620 23 40. Please check if the amount is correct or not. Is the amount correct? Okay. Now you have cancelled the contract. Now tell me what is the amount of compensation that you will pay. Compensation to be paid. Is 2000 options, 9 directors, 95 you will have to pay. So what is the amount that you will pay? Tell me. 2000 into 9 into 95 is 17 lakh 10,000. Okay. Now from this, what is the amount that you will adjust with SBP reserve? You will adjust 2000 multiplied by 9 multiplied by 90. Wonderful answer. Okay. 90. What is the amount? 16 lakh 20,000. Okay. Now what is the amount that you will transfer to P&L? 90,000. Very good. Okay. Now tell me again further. What is the balance in SBP reserve now? Uh, 2340 minus 1620, 720. You will transfer this to retained earnings. Let's pass journal entry firstly. So first is you will pay compensation. So SBP reserve account debit, P&L account debit to bank. How much? It is 16, 20, 90, 16.2 lakhs, 0.9 lakhs and 17.1 lakh. Agree? Now what is the balance in SBP reserve? 7.2 to retained earnings. Is it clear, everyone? Just see here entries, is it the same? Right? SBP reserve account debit, P&L account debit to bank up to the fair value on the date of cancellation, balancing figure, amount paid. Right? Now transfer the balance of SBP reserve to retained earnings. Clear, everyone? Wonderful. So this is the discussion on the cancellation of the share based payments which is given to the employees. Now see, understand the I discussed the modification, I discussed the cancellation, but for both I discussed only the equity settled. I didn't discuss the cash settled. Why? If it is cash settled, don't you think, first thing, let's talk about modification first. Modification in case of cash settled. Don't you think in modification we anyways account for the fair value only, right? So this is not required. Now, in cancellation, we anyways pay cash only. So the concept of cancellation is not applicable itself, right? Why we are cancelling? Just that the equity doesn't get diluted, right? In that we are already paying cash, so doesn't come the question of that. And even if we want to cancel the cash settled also, I'll pay it off now. Whatever is the liability, I'll pay it off and settle it off, right? So no question, no challenge in that case. So we have discussed the normal cases of equity settled, cash settled, the market based condition, non-market based condition. We discussed the equity settled modification, equity settled cancellation, modification, whether it is favorable or unfavorable. Also we discussed that in case of cash settled, modification and cancellation will not be applicable itself, okay, and we discussed the reason for that also. Tell me if you guys have any queries so far. Everything clear? Good. Now comes SBP with settlement alternative, which is becoming a very attractive topic these days from an exam perspective, you can say. Now I'll say that treat it is a compound financial instrument. From a financial instrument perspective, treat it as a compound financial instrument. Now, what is the meaning of a compound financial instrument? We just check what is the issue proceeds, we check what is my value of financial liability, compare the difference, whatever is the difference remains is my equity. Can equity be negative? Can equity be negative? No, right? Similar thing applies here also. Let's suppose if the value of equity we'll calculate the value of financial liability, in this case that is SBP liability. If value of equity option is higher than the value of cash option, the difference will be the equity. If the value of equity option is lower than the value of cash settled, the equity will become 0 but not negative. Clear everyone? Okay. So the accounting treatment on the grant date. Okay, see, understand, we are discussing this split of equity and liability always happens on the grant date, whether it's a SBP with settlement alternative or whether it's a compound financial instrument itself. Okay. Now, so what we will do is calculate the fair value of the equity option, which will be equals to the number of equity options multiplied by fair value on grant date with restrictions. Now, why we are writing here with restrictions? Understand, whenever the equity is given to the employees, that is given with restrictions, because what will happen, let's suppose Zomato gave ESOPs to its employees. Okay, the employees will what will employees do? They will try to sell in the market, realize the cash. If all the employees start selling the ESOPs, the price will start falling down, right? So there is a restriction in the sale period. Okay, so that you cannot sell within this period. Now, so what happens? That's the reason why I'm writing here with restrictions. Now, second is calculate the fair value of the liability option, that is number of cash options multiplied with the fair value on the grant date. Okay. The third is value of equity option will be equals to fair value of liability minus fair value of equity. Is it clear, everyone? Okay. Now, this note is very important. If the fair value of equity option calculated in step 1 is less than or equal to the fair value of liability component, then the value of equity component will be 0, but it cannot be negative. It cannot be negative. Is it clear, everyone? Now, accounting treatment during the vesting period, the period over which we are satisfying the vesting conditions, is recognized as expense and SBP reserve for equity option, recognized as expense and provision for SAR or SBP liability for cash settled option. Is it clear, everyone? Come on, guys, is it clear, everyone? Now, see, we discussed the accounting treatment for settlement alternative options. On the grant date, we'll do the split. During the vesting period, we'll recognize the expense and SBP reserve or service payment liability. Now comes the question, what will happen on the exercise date? Okay. See, understand, what is the meaning of settlement alternative? Means the employees will have an option that they can take cash or they can take equity. Okay. Now, the exercise date is very important here. If the employees come for cash settlement, what will I do? I do have a liability recorded for that. I pay off the liability, whatever is the equity recorded, I will transfer to retained earnings. Clear? So that's what it is. Pay off the liability at intrinsic value, transfer the SBP reserve to retained earnings. But if the employees come for equity settlement, tell me initially on the grant date, what did I do? I just recorded the equity for the differential portion, not for the whole equity component, right? The whole equity component is ideally recognized in the liability part. So what I'll do, I'll first transfer the liability to reserve now, okay? And then from that reserve, I will issue equity shares. Transfer the SBP liability to reserve now. So that's what I'm doing. See, provision for liability, the SBP liability, I'm transferring to reserve first. Now from this reserve, which I've transferred here, I will receive the exercise price from the employees, and then I'll issue the equity shares. See, bank account debit for exercise price, SBP reserve the carrying amount plus the liability amount, right? Now from there, I will issue the equity capital and the premium. The differential is the premium. Is it clear, everyone? Wonderful. Now, see, practically it will not be the case that all the employees are exercising cash or all the employees are exercising in equity. It might be the case that few employees think the equity might be a good option, few employees think that cash is a good option. Okay, so it can be partly in equity, partly in cash, and also it can be the case that partly lapsed. It can be the case. Okay, now, so what you have to do, if for the part which is equity driven, I will do this accounting. For the part which is cash driven, I will do this accounting, and for the part which is lapsed, I will transfer to retained earnings. Clear, everyone? Now there comes a question. This question has been asked in November 2022 itself for 6 marks. Okay, and don't you think that if it is asked in November 2022, it will not be asked in May 23. So you cannot predict ICI. Okay, so please solve this question. And I don't think so there is anything to be solved from my side in this question. So please solve it. I'm giving you 5 minutes time. So what is the value of equity option? Tell me on grant date. Equity is valued at 80,000 options. What is the equity price with the restriction 125 on the grant date? Now what is the value of cash settled option? 70,000 multiplied, what is the price? 136. So you know why this fair value is reduced in 125 for equity? Because there is a restriction. In cash there is no restriction, right? So what is the value? So 80,000 minus 125 is 80,000 multiplied by 125 is 1 cross 100 lakhs, and 70,000 multiplied by 136 is 95.2 lakhs. Is 4.8 lakh is your equity. Clear? Now here you will say your equity is valued at 4.8 lakhs and your cash is valued at 95.2 lakhs. Right? Now what you will do, how will you recognize the expense? Expense will be how much? 1.6 lakhs. Expense will be 1.6 lakh. Expense will be 1.6 lakh, right? Over the 3 years. Now for cash, it will not be that way. For cash, what we do? We'll calculate on the every year. So that is 70,000. Let's calculate it. 70,000 multiplied by 141. I'll write the fair value here. 141, 143, 146. 143 and 146. Okay, into 141 into 1 by 3. So what is the amount? Pardon? 32.9 lakhs. Now here it is again 70,000 multiplied by 143 multiplied by 2 by 3 minus 32.9 lakhs, which is equals to 70,000 into 143 into 2 by 3, 32.9. Pardon, 33.83. And here it is, the expense, tell me. 35.46. I am not calculating, I am writing what exactly you guys told me. This is the expense, 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 this is the expense. Okay. Now what is the entry? The journal entry will be again employee benefit expense account debit to share based payment reserve to share based payment liability. This is equals to reserve will be 1.6, it will be 32.9, it will be 31.6, it will be 33.83, it will be again 1.6, it will be 35.46. Okay, can you please total it and tell me? 1.6 plus 32.9 is 34.5. 35.43 and 37.07. Okay, fine, fair enough. Now, so this is what we will record. Now, equity will have a total balance of 4.8 here, and liability will have a total balance how much? Tell me. 32.9 plus 33.83 plus 35.46 is 102.19. Is what, right? Now, see what is the question. Past journal entries if the cash option is exercised. What will I do in this case? I will just pay it off. I will pay SBP liability account debit to bank 102.19, right? And I'll transfer this to retained earnings is how much? 4.8 lakhs. Clear? Second part. So the first part is clear now. The equity option. If I have to settle in equity, this is the first part. Now the second part. If I have to settle in equity, then what will I do? I will first transfer liability to what? Very good. And then? Very good. So what is the value? 102.19. 102.19. Okay. Now, what is the value of my SBP reserve now? It was 4.8 plus 102.19. It becomes how much? 106.99. Okay. Now, further, any exercise price to be called? Given in the question, any exercise price? No, not given. Fair enough. No issues. What I will do here, SBP reserve account debit to equity. How many shares? 80,000. 80,000 into 100. Right now, to securities premium. So it was 106.99 lakhs. This is 80,000 multiplied by 100 is 80 lakhs. It's 26.99 lakhs is the answer. Is it clear, everyone? Now, write third part in your notebook as an assignment. Okay. 50% of the or let me just a minute. 35,000 of the options were settled in cash. 35,000 options were settled in cash, remaining in equity. Okay, please solve this question as an assignment. Now, so this completes our discussion on share-based payment to employees. Okay, just I'm reiterating the revising whatever we discussed. First, we discussed the meaning of share-based payments. I believe it is clear, everyone. Then we discussed about the fair value. For equity settle will take on the grant date. For cash settle will take on the reporting date. Every reporting date. Okay, even if the vesting period is over, during the exercise period also we'll keep on remeasuring it till the time it is settled. Okay, now when it gets settled, the cash settle option will settle it at intrinsic value. Whatever is the difference in the fair value or difference between the fair value and intrinsic value will be transferred to P&L. Okay, now whether it is cash settled or equity settled, I will book the expense in the P&L as employee benefit expense. If it is cash settled, I'll record a subsequent reserve. If it is cash settled, I will record a liability. Correct? If it is equity settled, I will record a reserve. If cash settled, I record a liability. Now, following that, if it is equity settled on exercise date, it might get exercised or it might get lapsed. If it is lapsed, whatever is the reserve transferred to retained earnings. For cash settled, it will not get lapsed only, right? Now, further, we discussed about modification or repricing. For the modification or repricing will not be applicable for the cash settled. If it is there, will account for anyways with the fair value changes. For equity settled, modification or repricing, whatever is the incremental fair value on the date of modification, that is compare the fair value just before modification and after modification, but both the values have to be on the date of modification itself. Okay, compare these two values and apportion as an expense over the remaining vesting period. Then came cancellation. For cancellation, book the entire remaining expense in the year of cancellation. Then further, what you have to do, whatever is the fair value on the date of cancellation, pay from the SBP reserve. Any excess amount which you pay over and above, any excess amount which you paid over and above fair value on the date of cancellation has to be transferred to any amount which you pay to the employees on cancellation of the ESOP or the any ESOPs over and above fair value on the date of cancellation will be transferred to P&L. Now, any differential remaining in the SBP reserve will be transferred to retained earnings. Okay, I hope it is clear, everyone. Then we discussed about settlement alternatives. So for settlement alternative, treat it as a compound financial instrument. In the compound financial instrument or in share-based payment with settlement alternatives, what we do here is we calculate the full value of equity, we calculate the full value of liability. Okay, recognize the liability at its full value, but recognize the equity at its differential value. Okay, but the equity can be zero but cannot be negative. Okay, now recognize the expense accordingly. Now, okay, the equity portion like you can say SLM basis, but for the liability portion we'll remeasure it on every reporting dates and recognize it on the settlement date. What if it is equity settled, I will transfer the whole of liability to equity and then settle it. If it is cash settled, I will pay off all the liability, whatever is the balance in SBP reserve, I will transfer to retained earnings. If it is mixed, we will do the mixed treatment. Clear, everyone? Good. Now comes the SBP to non-employees, which is very easy. See, it starts here, it ends here also. Now, understand. See, non-employees means what? Either I have taken purchased any assets, or I have taken any services, or I have purchased any goods from the vendor, and I have promised to pay the consideration in the form of shares of my company. Now, if there is an asset or expense, okay, it says I will record these at fair value of the assets or services. I will record these at the fair value of the assets or services. Okay. Now, the following with the SBP reserve and following the provision for SAR, or you can say SBP liability. Now, from SBP reserve, I will issue equity share capital, that is number of shares multiplied with the face value, and differential portion will go to securities premium. But this provision for SAR or SBP liability, I will pay at intrinsic value to the vendor. Okay. So basically, understand, whenever I do any transaction with a non-employee, I will record the assets or the goods or the services which I have received at its fair value and not at the fair value of the good shares. Okay. If at all the fair value of the goods or services are not available, then we can take the fair value of the shares. Okay. So now, in case of continuous long services, basically might be services are to be given through 2-year period or 3-year period. Okay. And after 3-year period, I will give the shares, like similar to what is given in the employee's service condition. Recognize expense on accrual basis. Okay. Now, understand, in 1638 and 40, India 1638 and 40, we studied barter transactions, right? That is exchange of assets. And we know whenever the assets we have acquired on exchange, we record the assets at fair value of the asset given up, right? Recognize assets acquired at fair value of assets given up. But this was the case to be applied for 1638 and 40. But Ind AS 102 gives an exception to it. In the case the asset is acquired by issue of shares of one entity, Ind AS 1638 and 40 says what? Fair value of the asset that you have received. Okay. So this is an exception to the general rule. So it says we have to record the asset. Ind AS 1638 says not apply, and entity will recognize the asset at its fair value, that is fair value of asset received, not given up. Given up is in the case of 1638 and 40, but here it is received. Clear, everyone? This is an exception, though this concept has not been tested so far, but I believe it can be tested because this is an important concept. Is it clear, everyone, so far? If anyone has any queries, we can take it up now. Come on, guys, any query? Now, shall I move ahead then? Okay. So, group share based payment plans. Now, what happens? Reliance Industries is listed, right? But Jio is not listed. Assuming Jio is a subsidiary of Reliance, though practically it is not, but assuming it is a subsidiary. Okay, now, to give motivation to the employees of Jio, if I say I will give you the shares of Jio, will the employees be motivated? No, it's not listed, right? But if I say that I will give you the shares of Reliance, they will get motivated for that, right? So what happens? But the employees are working for the subsidiary, but the shares are given by the parent company. So this is called as group share based payment plans. And many times what happens is subsidiary company is listed, and the employees are working for the parent company, right? So what happens? Parent company gives the shares of the parent company to the employees of the subsidiary company. Okay, now tell me, who is receiving the services? Subsidiary company. Who will record the expense? Subsidiary company. Okay, very good. Now, who is issuing the shares? Who is issuing the shares? Parent company. Who will record the reserve? Parent. So, parent company will record the reserve. Understand, the entity who issues the shares will record the reserve. Entity who receives the services will record the expense. But now, if I have to say the subsidiary company recorded employee expense, parent company recorded reserve, the debit of the parent company and the credit for the subsidiary company is blank. Why? Now tell me, why will parent company give the support the employees of subsidiary company? It's like an investment. Very good. So the parent company is investing in subsidiary, right? So it's an investment in subsidiary. Here it's an equity contribution from a parent company. Okay. Now similarly here also. So what we'll do? Subsidiary company is giving the subsidiaries to the parent company, right? The employees of parent company. So definitely the parent company will record employee expense, but the subsidiary company will record the reserve. But now I cannot say subsidiary company is investing in the parent company, right? But we can definitely say that it's an equity treatment between both of them. Clear? So that's only. So see, the parent group service payment plan is not something very difficult. Okay. Just understand whatever is the expense has to be booked by the company who receives the services. The company who gives the shares will record the reserve. Okay. Now, if you go practically, what you will see, parent company is recording the expense and parent company is recording the reserve. And at the end of the year, it will cross charge this expense to the subsidiary company. Basically, it will reverse all the expenses and transfer all the expenses to the subsidiary company. Okay. So that's what will happen. I believe it is clear. Now, when we prepare console FS, everything will get knocked off and clear. Now, deferred tax for a share-based payment transaction. See, understand. Share-based payment transaction. If it's cash settled or it's equity settled. Okay. If it is cash settled, definitely I'll get a deduction for it. That's an expense for the company. Right now, if you can recall in Ind-AS 12, and this is the liability, right? We will have a carrying amount of the liability. We can calculate the tax base of the liability, right? We can calculate temporary difference. We can assess whether temporary difference is taxable temporary difference or deductible temporary difference. If it is taxable temporary difference, we can calculate deferred tax liability. If it is deductible temporary difference, we'll assess it for the concept of prudence, whether the criteria is being met or not. If it is met, we will recognize deferred tax asset. Very simple. Coming to equities, it is not that simple. In certain jurisdictions, we get the deduction. In certain jurisdictions, we don't get the deduction. Okay. If we don't get the deduction, don't you think it becomes it is not a temporary difference. Basically, we are recognizing the expense in our accounting books, but it will not be recorded as an expense in the tax books in any case, right? Because it is not tax deductible. So if it is not tax deductible, will not create any deferred tax. Will not get any deferred tax, right? But now, if it is deductible, equity, definitely we do have a carrying amount. But in Ind-AS 12, does it say about tax base of a equity? No, it says about asset, it says about liability, but not about tax base of an equity. So that's the reason why the standard directly says the temporary difference is the future deductions. Whatever is the future deduction that you will get from that from this transaction is your temporary difference. So basically, for an equity settled which is tax deductible, you are not required to calculate carrying amount. You are not required to calculate tax base. Directly, standard gives you this one. The temporary difference is equal to future deductions, and you have to recognize the deferred tax asset of that. Is that clear, everyone? That's all from a share-based payment as well. Now tell me, guys, if you guys have any queries in the share-based payments or in leases, definitely we can take it up. Pardon? Okay, that's a mistake. I think that you can remove it off. Come on guys, tell me your queries. If there are no queries, can we wrap up the class? Okay. So tomorrow we'll be studying revenue, and we'll be starting with the financial instruments. Okay. Same timing.